In the spring of 2024, the United States government declared war on TurboTax by launching a product whose sole purpose was to make one of the most profitable software companies in American history permanently obsolete. The program, called IRS Direct File, represented something no private competitor could ever hope to match. A federal government operating on a $6.1 trillion annual budget, armed with the legal authority to require virtually every American to file taxes, and backed by an institutional credibility no advertising campaign could ever purchase, had decided to build its own free tax filing software, and in doing so make TurboTax irrelevant through executive action rather than market competition. Wall Street reached the same conclusion almost instantly. Not another government pilot, but an existential threat. Intuit stock fell, analysts downgraded, and commentators were suddenly convinced they were watching one of Silicon Valley's most dependable businesses die. The logic seemed airtight. If the government files your taxes for free, why would 160 million Americans keep paying private companies to do it? That was a convincing argument, but it came with one problem. Almost none of it happened. Direct File attracted a fraction of its projected filers, landed with a lukewarm response, and was quietly killed within a single tax season. Meanwhile, Intuit grew revenue 17%, pushed its operating margin past 40%, and walked away from a fight with the US government stronger than it went in. Most companies facing a free, government-backed version of one of their core products simply loses. So the question isn't whether Intuit survived, the question is why. And the answer to that is also the answer to why the stock, now 48% below its high with $20.9 billion in revenue and an 81% gross profit margin, might be one of the more interesting setups in large cap software right now. But to get there, you first need to understand what this business actually is. Take a look at that revenue breakdown here. 8 years of Intuit's revenue split across every major product line. The thing that immediately stands out is how uniformly every single bar moves upwards. Total revenue has compounded from $5.2 billion in 2017 to just over $20.9 billion in the most recent 12 months. Online ecosystem revenue also has grown at a compounded annual rate across 8 consecutive fiscal years. Through multiple rate cycles, a global pandemic, a government-sponsored tax on one of its core products, and a wave of artificial intelligence anxiety that has taken 48% of the stock price. That is not luck, that is architecture. And to understand this architecture, you always need to start with a foundation. Intuit runs through 2 segments. Global Business Solutions, which generates roughly 60% of total revenue, is the home of QuickBooks. The Consumer segment, which generates roughly 40% of revenue, contains TurboTax, Credit Karma, and a professional tax division that serves tax professionals. Each of these feeds the others in ways that are genuinely hard to replicate from the outside. But the foundation underneath all of it, the one that was quietly laid over 3 decades before anyone fully appreciated what was being built, is QuickBooks. Running the finances of a small business has always been a specific kind of suffering for anyone who went into business to do something other than accounting. The restaurant owner who cooks the best food in the neighborhood does not want to spend Sunday evening reconciling bank statements. Contractor who builds excellent homes does not want to wait through 600 transactions for his tax appointment trying to remember what he bought at Home Depot in February. For years the available solutions were expensive, technically demanding, or unreliable. Enough that most small business owners simply lived with the problem and tried to catch up before April. QuickBooks solved this not through a single brilliant idea, but through a carefully engineered system that made the tedious parts of running a business nearly invisible. Connect a bank account and the software automatically pulls every transaction the moment it clears. Photograph a receipt with a phone and the system reads the vendor, the amount and the date, then matches it to the corresponding bank entry without a human involved. Artificial intelligence categorizes expenses into the correct accounting buckets. An invoice goes out and the platform tracks whether it has been paid, following up automatically if it has not. One click generates the profit and loss statements already formatted for a tax professional. That is a genuinely useful product. But the real genius of QuickBooks was never the software itself, it was the distribution network built around it. And understanding that network is understanding how one company came to own over 80% of the small business accounting market in the United States. Intuit understood something that every competitor consistently underestimated. And the person who controls the accounting relationship for most small businesses is not the owner, it is the accountant. When Intuit began providing free QuickBooks licenses to American universities 2 decades ago, it was making an investment in distribution that would compound for an entire generation. Roughly 70% of practice-oriented accounting programs in the United States teach on QuickBooks today. Students spend 2, 3, 4 years learning the craft of accounting through this specific interface until the workflow becomes second nature. Coursera's Mastering QuickBooks 2025 course alone has enrolled more than 568,000 learners, while more than 25,000 students completed free QuickBooks certifications in 2023. And every single one of them is a future professional who will spend the next 30 years recommending a specific product to every business client they take on. When a certified accountant builds a client base, directive to new clients follows a predictable pattern. So, you need to be on QuickBooks, and it's not because Intuit is compensating that. Accountants say so, because it is what makes the accountant's job faster, more reliable, and easier to scale across a growing practice. More businesses use QuickBooks because their accountants require it. More accountants build expertise in QuickBooks because their clients are already on it. And every year it becomes measurably harder for any competitor to break that cycle from the outside. Now look at what that flywheel actually produces over time. QuickBooks Online accounting revenue alone has gone from $448 million in 2017 to $4.8 billion in the most recent 12 months, accounting for roughly 23% of the business revenue. That is a compounded growth rate of 31.2% over 8 consecutive years. You can see the desktop version as a smaller portion in this chart, accounting for 14% of revenue, shrinking steadily as a share of the total. That shift is exactly what Intuit wants. Every business migrating from a desktop license to a cloud subscription represents a permanent increase in revenue per user and a permanent increase in what it costs that customer to leave. Because here is what happens after business joins the platform. A business comes for the accounting and stays for everything else. Start with employees. QuickBooks Payroll calculates wages, automatically remits US payroll taxes, and deposits salaries straight into bank accounts. Once it's running, it's the backbone of the operation, and you don't swap that out on a whim. Intuit earns twice: a fixed monthly fee plus a flat charge per employee. More employees, more revenue, automatically. Same principle with QuickBooks Time, which tracks hours and shifts by GPS, in SaaS language PEPM. Per employee per month. When the customer grows, the bill grows on its own. And subscribe to payroll at a higher tier, and time comes bundled in. No second contract, no friction, pulling the customer deeper into the ecosystem. Intuit even turns broker, cross-selling health insurance and 401ks to employees and collecting a commission on every deal. Then comes the second big play, the money strategy. This is Intuit's push to become the financial operating system of small businesses. To own the entire cycle of money moving through a company, it breaks into 4 parts. First, money in. First, money in through QuickBooks payments. When a business sends an invoice, Intuit is the payment processor, taking a cut of every transaction like Stripe or PayPal. Money out through QuickBooks Bill Pay, automating vendor payments, monetized through software tiers and transaction fees. Money store through QuickBooks Checking, an integrated business account where Intuit earns on card interchanges and interest on deposits. And money lending through QuickBooks Capital, short-term loans issued natively inside the platform, underwritten against the live financial data Intuit already holds on that exact business. And that right here is the real edge. No traditional bank on earth has as much real-time granular data on small businesses as Intuit does. Intuit sells it incrementally more over time. Payroll processing, bill payment automation, customer payment handling through QuickBooks Payments, short-term business loan through QuickBooks Capital, underwritten against the live financial data the system is already collecting on that specific business, an integrated checking account that earns interest through a partner bank. Each service layered into the relationship raises the switching cost meaningfully. A business running payroll, processing customer payments, borrowing capital, and maintaining its bank account inside a single platform is not switching to a competitor to save $40 a month. The math simply does not work in either direction. And here's what all those layered services produce in aggregate. This chart tracking online services revenue shows growth from 410 million in 2017 to 4.7 billion today, accounting for 22.5% of revenue at a compound annual growth rate of 32%, as I told you. But here is a problem that Intuit eventually had to solve. The natural ceiling on QuickBooks relationship had always been the customer's own success. When a business grew complex enough, managing multiple subsidiaries or requiring detailed financial reporting across different legal entities, it would outgrow the software and migrate to enterprise systems like Oracle NetSuite. NetSuite implementations typically require six-figure consulting fees and deployment timelines measured in months. Intuit built the enterprise suite specifically to intercept those customers before they could leave. The product targets businesses with 50 to several hundred employees, an annual contract ranging from $20,000 to over $60,000 per year, representing a 4 to 10 times expansion in annual revenue from that customer at minimal additional infrastructure cost. The suite is growing at over 40% year over year. The structural advantage it holds against competing enterprise products is simply that staying inside the Intuit ecosystem means migrating in days with all historical data intact and the staff already fluent with the interface. Moving to a competitor like NetSuite takes 6 to 12 months and often costs over $100,000 in consulting fees before the product is even live. This is not a technology competition. That is a switching cost so large that most businesses refuse to pay it even when they have a legitimate reason to leave. There is one notable exception to this pattern of compounding success, and it deserves honest treatment. In November 2021, Intuit closed its acquisition of Mailchimp for approximately $12 billion. Mailchimp held over 70% market share in email marketing for small businesses. The acquisition logic was sound. A company already using QuickBooks for accounting might naturally want to run its marketing campaigns through the same ecosystem. The execution did not match the thesis. Intuit restructured Mailchimp's pricing in ways that frustrated the existing user base almost immediately. The free tier was cut from 2,000 contracts to 250, eliminating the viral entry point that had grown this product organically for years. Competitors moved aggressively to capture the businesses that began leaving. Market share has fallen from over 70% to the low mid 50% range, and the product contracted in revenue last fiscal year. Intuit has guided for a return to double-digit growth by 2027 and acknowledged that selling the business is a path they would consider if the recovery does not materialize. This is the one chapter in the Intuit story where the empire made a large bet and has not yet collected on it. Now consider what TurboTax is actually doing, while everyone debates whether artificial intelligence will make it obsolete. Let's start with the market itself. Around 160 million tax returns get filed in America every year, and that number splits almost evenly into two halves. On one side, the do-it-yourself crowd, roughly 80 million filers, where TurboTax dominates with about 60% of the market. But this is a mature game. Raw volume has stopped growing. TurboTax federal units are actually slipping, and free options like the IRS Free File program keep squeezing margins at the bottom. On the other side, the assisted market. People who want professionals to handle it. Also about 80 million filers, but Intuit pegs this one at roughly 22 billion, making it twice as lucrative as do-it-yourself. And that's exactly the point. This is where the growth is. The assisted side is Intuit's real expansion frontier. Everything it builds next is aimed straight at it. And to understand why that frontier is so valuable, look at the tension the whole market lives inside. Filing is routine enough that software handles most cases with ease, but specific enough that people would rather pay for help than risk an error on a legal binding document sent to the federal government. TurboTax has lived inside that tension for 30 years and build brand trust that's genuinely hard to manufacture from scratch. When the IRS rolled out a free alternative, most eligible Americans still chose to pay for the private product. That trust became measurable in real time. Look at TurboTax revenue plotted here alongside total consumer revenue and total company revenue across 8 years. 25% of total revenue and 62% of the consumer segment. The headline compound growth rate of 9.6% of TurboTax actually understates what is happening inside the product, because TurboTax is effectively splitting into two distinct businesses, growing at very different rates. The traditional segment, where a consumer uses the software to complete their own return, is growing slowly and declining at the lower end of the income scale. Price-sensitive consumers have migrated toward free alternatives, and Intuit has allowed this to happen deliberately, because those customers generated minimal revenue. Losing them has actually improved the overall margin profile of the segment. The assisted segment, called TurboTax Live, is expanding at 36 to 40% annually and now accounts for roughly 12.5% of total revenue. As a standalone revenue line, it has approached $2.8 billion, growing nearly even with H&R Block, who is Intuit's biggest competitor in this segment. Entire assisted tax operation by revenue, despite Intuit only running 600 physical offices in the country. Economics work because artificial intelligence now performs approximately 90% of the preparatory and diagnostic work on each return. A credentialed human expert reviews the output, handles the edge, cases system flags, takes legal accountability for the filing, and gives the customer confidence that a qualified professional signed off on the final document. The consumer segment operating margins run between 47 and 48% as a result. This is the product the United States government tried to replace with something free, and the customers chose to stay, which becomes even more striking when you pull TurboTax Live out of the broader revenue picture and look at what it has actually become in competitive terms. TurboTax Live is now the single largest assisted tax provider in the whole country. Number 1. H&R Block, the old analog leader, is stuck fighting low single-digit growth and losing market share, while Intuit has already matched it on revenue and keeps pulling away at 36 to 40% a year. That's the whole picture. Intuit is the leader in both worlds at once. The do-it-yourself monopolist at around 60% share and the fastest growing, highest revenue player in assisted. And because the same tax engine runs underneath both, every dollar TurboTax Live brings drives the entire consumer segment's margins higher. Now look at what made that loyalty possible on a structural level. Intuit acquired Credit Karma in December 2020 for approximately $8.1 billion. At the time, it looked unusual for a company whose identity was built around accounting and tax software. Looking back, it was the move that explains why the entire ecosystem has become so difficult to penetrate from outside. Credit Karma holds over 140 million registered user profiles. Each one contains credit scores, financial history, outstanding debt balances, income estimates, and asset tracking data. The platform is completely free to consumers and monetizes through referral commission paid by banks and financial institutions when a user accepts a credit card, personal loan, auto loan, or insurance policy through a recommendation the platform surfaces. The Credit Karma revenue history inside Intuit tells the story of a model that is cyclically sensitive but structurally intact. The 2022 figure of $1.8 billion reflects the first full year inside the portfolio. The dip in 2023 to $1.6 billion reflects a high interest rate environment where lenders stopped approving as many personal loans, compressing referral commissions. That is not a structural problem. It is the demand sensitivity you would expect from any financial marketplace when rates move sharply. The recovery to $2.2 billion in fiscal year 2025 and $2.5 billion in the most recent 12 months confirmed the underlying model works. The technology that makes the platform genuinely valuable is a system called Lightbox. Traditional financial comparison tools show users a list of products and let them apply blindly, generating high rejection rates and hard credit inquiries. That damages the scores those platforms are supposed to help. Lightbox works differently though. Partner banks upload their proprietary underwriting criteria directly into Credit Karma's secure infrastructure. The platform runs a real-time simulation against each user's specific financial profile before any application is submitted. Users see only offers where their probability of approval is genuinely high. Lenders receive a pre-qualified lead with a higher conversion rate. Every participant benefits simultaneously, which is why lenders keep paying for access to it. But the synergy with TurboTax is where the full strategic value of the acquisition becomes clear. Every spring, Intuit can reach over 140 million users directly inside an app they already open regularly, at zero additional advertising cost, and direct them towards TurboTax. Because Credit Karma already holds their financial profile, clicking through opens a return that is already partially populated. Income data fills in automatically. Known deduction categories surface without the user entering anything manually. The friction of starting a tax return from scratch disappears entirely. The number of TurboTax filers arriving directly from within Credit Karma is projected to grow 54% this year. And when the refund arrives, it can be routed directly into a Credit Karma Money account, keeping that customer inside the Intuit ecosystem for the remaining 11 months of the year until the cycle begins again. The entire thing is self-reinforcing in a way that no single competitor is positioned to attack because it is built across multiple product lines simultaneously. Now look at what every competitor is actually up against when they try to take on any piece of the system. In accounting software, Xero is the most technically sophisticated challenger. Its global revenue has compounded at 28.1% annually since 2017, growing from $295 million to $2.75 billion. Looking at the global picture here, it holds dominant market positions across Australia and New Zealand. But in the United States, Xero controls roughly 8% of the accounting software market, against QuickBooks holding over 70%. Now shift to the US specific chart and the picture becomes even clearer. Xero's American revenue grew 35% last year following its acquisition of B2B payments platform Mailchimp, jumping from $340 million to $424 million. That's genuine acceleration, but $424 million in US revenue against QuickBooks Online Accounting at $4.8 billion shows you exactly where the entrenched position sits. The structural reason Xero has not broken through, despite years of sustained investment, is that it outsourced critical services including US payroll processing to third-party partners. That means splitting lucrative transaction fees and introducing integration complexity that Intuit avoids entirely by handling everything in-house. In the mid-market segment, we have Sage. Sage tells a fundamentally different story. This chart shows revenue compounding at just 6.4% annually, effectively flat in the $1.9 to $2.5 billion range across 8 years. That is what a business looks like when it has conceded a segment it used to lead. Sage has repositioned around upper mid-market enterprise deployments and largely abandoned the small business space where QuickBooks generates its most durable returns. And in the assisted tax market, look at H&R Block. Approximately $3.9 billion in revenue today, growing at a compound annual rate of just 2.7% over the past 8 years. TurboTax alone is approaching $2.8 billion and expanding at 36 to 40% per year. Company running 10,000 retail storefronts, staffed by credentialed tax professionals, is steadily losing ground to a competitor that operates with only 600 physical locations. When you hold those two trajectories side by side, it tells you something important about where the industry is heading and why. Which brings us to the big one, artificial intelligence, and a part of the story where most of the investment community has drawn exactly the wrong conclusion. The standard one concern is that AI will commoditize the core functionality of QuickBooks and TurboTax, enabling new entrants to deliver equivalent services at far lower prices. The fear is that Intuit becomes just another legacy platform in a world where better, cheaper alternatives proliferate quickly. It is a logical concern, but it makes a fundamental assumption that does not hold. It assumes Intuit starts the AI era from the same position as a startup with a good idea and access to frontier models. Well, it does not. Intuit began realigning its entire technology strategy around artificial intelligence in 2019, well before the current wave of generative AI entered mainstream corporate conversation. The infrastructure it built is called GenOS, a proprietary AI operating system that deploys a combination of Intuit's own financial language models, trained specifically on tax, accounting, and payroll data, alongside frontier models from providers including OpenAI and Anthropic. No AI startup building a competing product today has access to what Intuit has accumulated over 30 years. The historical transaction data of millions of small businesses, the tax return history of tens of millions of American consumers, payroll records, cash flow patterns, credit profiles, and financial histories that have flowed through these platforms continuously since the 1990s. AI models trained on that proprietary data are materially more accurate in financial context than any general purpose model. And in this domain, accuracy is not a product feature. Hallucinated figure in a tax return or payroll calculation produces real legal consequences for a real person. Accuracy is the minimum requirement for the product to be legally usable at all, which means the proprietary data is not a marginal advantage. It is the foundation the entire product is built on. The commercial deployment is already producing measurable outcomes. Over 3 million customers have used Intuit's AI agent products. More than 85% of them return to use them again. That is a genuine re-engagement metric, not a trial figure. AI now performs approximately 90% of the preparatory work on TurboTax live returns. The company has deployed AI agents across accounting, bookkeeping, payment processing, and payroll within QuickBooks, each drawing on the same proprietary data infrastructure that no new entrant can replicate by licensing a foundation model from a third party. Now look at the financial architecture that 30 years of compounding has actually produced, because this is where the real case for the business becomes impossible to ignore. First, we have the margin structure across 8 fiscal years. Gross margin, operating margin, and net profit margin all plotted together. The gross margin line sits between 79 and 85% throughout every macroeconomic environment, every major acquisition, and every competitive challenge this company has faced. The stability is a direct measurement of pricing power. Intuit raises prices on QuickBooks regularly, often generating vocal complaints from small business owners, and churn rates remain low because the cost of leaving exceeds the pain of the increase. Operating margins dipped following the Credit Karma and Mailchimp acquisition and have since recovered to 27.5%, with net profit margins at approximately 22%. Return on invested capital adds an important layer to that picture. Before the major acquisition, Intuit operated with a ROIC above 37%, reflecting a pure software business converting every dollar of invested capital into profit, at a rate almost no company achieves consistently. The Credit Karma and Mailchimp deals expanded the capital base dramatically, and ROIC dropped to near 10%. It has since recovered to 14.1%, and the trajectory is clearly upward, as both acquired businesses scale and goodwill amortization works through the financial statements. Cash from operating activities has compounded at 20% annually since 2017 and reached $7.9 billion in the most recent 12 months. The brief dip in 2024 visible in this chart reflects working capital timing rather than any deterioration in earnings quality. Free cash flow sits at $7.8 billion, reflecting the capital efficiency of a software platform that does not need significant physical assets to operate at scale. Most companies that generate this high level of free cash flow relative to their market capitalization do not trade 48% below the all-time high. Share repurchases reached $4.7 billion in the most recent fiscal year. The total share count, however, has not declined as dramatically as that volume might imply, because stock-based compensation running at approximately $2 billion annually offsets a meaningful portion of the buybacks. The repurchases represent genuine capital return, but evaluating Then net of dilution from employee compensation gives a more accurate picture of the net benefit to long-term shareholders than the gross repurchase number alone. The dividend per share has grown from $140 in 2017 to $4.7 today, a compounded annual rate of 14.9%. The investment case ultimately resolves into a single judgment. Artificial intelligence is either going to make this business more valuable over the next decade, or it's going to make it a lot less valuable. The current stock price, 60% below its all-time high for a company generating this level of free cash flow, reflects the market's genuine uncertainty about which direction that goes. The bearish case is coherent. AI commoditizes the core functionality of QuickBooks and TurboTax. Well-funded competitors deliver equivalent services at lower prices, and Intuit faces margin compression severe enough to undermine the multiple the stock currently commands. The case on the other side is that AI accelerates the advantage Intuit already has rather than neutralizing them. The proprietary data that makes Intuit's model more accurate than any general purpose alternative is the same data that powers every other competitive advantage in the portfolio. The customer relationships, professional networks, platform switching costs all compound together over time. The shift towards fully managed, human-in-the-loop services through TurboTax Live and QuickBooks Live means Intuit is converting software revenue into service revenue. The federal government tried the commoditization route directly, which with unlimited resources, zero cost to the consumer, and the full authority of the United States Treasury behind it, and it failed. Management has guided for 13 to 14% revenue growth and 17 to 19% operating income growth in the coming fiscal year. Whether that growth materializes is a question about execution quality, competitive positioning, and the pace at which AI disruption actually moves in regulated financial services where accuracy and trust can carry legal weight. What is not a question is the quality of the underlying business. Over 30 years, Intuit has compounded revenue at rates most software companies never reach. It has built network effects that have survived every meaningful shift in the technology landscape. It has created a customer base that renews at high rates even as prices rise. It has deployed an AI strategy built on 3 decades of proprietary financial data that no competitor can replicate by writing a check. The empire embedded so deeply into the financial lives of tens of millions of Americans that most of them use it without fully knowing its name has spent 30 years building a position that every competitor, including the United States government, has tried and failed to crack. The question for investors is not whether that position is real. The evidence here answers that clearly. The question is whether you believe the next wave of disruption is fundamentally different from every previous wave that came before it. Based on everything these numbers show, that is a much harder case to make than the 50% discount in the stock price might lead you to believe. If you found that useful, drop a like and let me know in the comments.